Well, at the end of the Q1 FY22 earnings season, we've seen quite a few strategy notes come in, some very important strategy notes coming in from the house of Citi as well as Morgan Stanley. Let's have a look at what Rhythm Desai of Morgan Stanley has to say as far as Q1 FY22 earnings season is concerned. What are the changes they've made? Which are the sectors and which are the packs as far as markets are concerned that have actually seen significant amount of re-rating and earnings upgrades. Rhythm Desai says that Sensex as well as Nifty reported revenue growth of 36 and 45% respectively in Q1. The broader market revenue and net profit growth actually stood at 44% and 145% respectively on a year-on-year basis. Interestingly, the share of the top companies as far as the net profit is concerned declined for the fourth consecutive quarter. Earnings growth was positive across all sectors, and he says that materials and consumer discretionary were the ones that actually saw significant growth revisions in this particular quarter. Q1 FY22 recovery rate for companies was better versus Q1 FY21. Now, what he is saying, materials and consumer discretionary are the ones that actually led the growth in earnings, while consumer staples was a significant laggard. He also says that energy reported the fastest growth in net profit, healthcare reported the biggest beat in earnings versus analyst expectations, and materials and energy sector saw the most earnings growth revisions in this particular quarter gone by. Now, when we come to Citi, what is it that Citi says? Surendra Goyal of Citi says that Q1 earnings were largely in line with the estimates. The NIFTY EBITDA was ahead of estimates in Q1. Earnings at 20% 2-year CAGR was slightly lower. The consensus earnings revision is now negative, and he says Q1 was impacted by COVID second wave. Nifty consensus estimates is still at a 35%, and this is something they say valuations at 21 times forward price to earnings is at an 80% premium as far as emerging market is concerned, and this is something that makes Citi quite defensive. He's saying that also the noise around the Fed taper is something that is beginning to grow, and this also reduces the comfort as far as lofty Nifty valuations and lofty price to earnings multiples are concerned in the equity markets. He's saying that they've tweaked the model portfolio, they've become slightly more defensive. The NIFTY September 22 target has limited upsides at this point of time at 16,700. The changes have been done to the model portfolio of Citi. They've reduced their overweight on beaten down sectors like autos. They continue to struggle with high valuations on defensives. Valuation in the context of market is quite attractive. Lot of overhang is already priced in. They are saying that some of their overweights are financials and industrials, and why industrials? They believe industrials are quite attractive as capex recovery starts in calendar year 2022.